John, how are you, sir?
I'm doing great. Spent the last few weeks on the road, different conferences and road shows that we've been doing, and it's kind of nice to get back in the office and get caught up with you.
Absolutely. Well, and of course, you've got a few things on your plate: uranium, copper, gold, maybe silver, to name but a few. So lots of different types of conversations happening out there. You don't have any lithium in the portfolio, do you?
We have a very small lithium portfolio with an ETF that we have in the U.S. Lithium has really continued to struggle this year. It definitely seems as though the market is a little out of whack in terms of new supply coming online and EV sales clearly slowing in a number of markets around the world. And it seems like everybody with a domestic car market is rushing to slap ever increasing amounts of tariffs on Chinese EVs because they are very concerned about these very low cost cars flooding into their local markets.
Well, I think we saw an announcement from GM last week, pretty much on that topic. I think they're going to be looking to slow down. So it'll be interesting to see how the various North American automotives react to this, but also companies. I was in Quebec City last week, so managed to host a couple of interviews on stage. It really is a time for companies who think they can actually get over the line and get into production and insert themselves into that North American ecosystem to kind of take advantage of this moment. Do you think?
Oh, there's huge strategic value in terms of being in this kind of north-south corridor, between lithium deposits in North America and South America. The OEMs, obviously, in North America are very focused on security of supply from friendly nations they have free trade agreements with, which are obviously going to get preferential treatment in terms of Inflation Reduction Act related EV tax credits and whatnot. I think, there has been a slowdown in the growth of EVs in a number of markets, and that obviously has taken some momentum out of the lithium market as well as some of the other battery metals. But I think the long-term trend is still for more EV adoption. We are going to get closer to price parity on a number of models. And I think that's key. I think the big issue is clearly anxiety about range. People are still nervous, especially, in places, non-urban centers, range is a big issue, infrastructure, charging infrastructure. But in urban centers where the average person is not driving very far, I think we will eventually see greater EV adoption as more models come to market, more infrastructure is put in place for charging. And in markets where these cheap Chinese cars are permitted, we're going to see it. I mean, when I was in Peru last year in Lima, I saw these Chinese car dealerships selling these $10,000 EV cars, and they are selling there. Yeah, people don't care. They're not going to pay $30,000 for a Ford car. They're going to pay $10,000 for one of these BYD cars. So it's going to happen. Obviously, traditional auto markets in Europe and North America are very concerned about a flood of very cheap Chinese imports. Remember that the Chinese really didn't have an auto industry in the traditional internal combustion engine. They missed that part of the curve, so they just went right to the next part, which was EVs and hybrids, and that's really what they're trying to dominate.
Well, it worked in Africa when it came to mobile phones and bank payments, so it could work for the Chinese. We shall see. Because I was talking to I think Lithium Royalty up on stage last week, and the first question to them was like, "Tell me it's going to be okay." And I think like you, I think that they believe it will. Well, they've got to believe it will, but that it'll be a slightly more accretive growth, slightly more accretive recovery. And perhaps not so many players jumping on the bandwagon, which may help investors in terms of trying to focus and get a sense of all the white noise that's out there. So I guess it's, to use your phrase from me last time, patience is required in this game somewhat, for sure. One of the other sectors which is flying at the moment, silver. They're really, and obviously helped by the recent results in Mexican elections. I think the general mood is quite positive there. What's your take on the silver market?
Yeah, silver, it's really nice to see it finally breaking out. It's, recently broken through $30 and is kind of flirting around. There's been a lot of daily volatility in silver. of late, which, is never really great in terms of building confidence. But it has kind of broken out finally. And it is obviously following gold's lead. We've been telling people for months now that gold was going to lead the breakout, and then silver was going to basically slingshot by, and it's starting to play out right now. But if you take a step back, silver price is still kind of where we were 3 years ago. So I still think we have a number of very frustrated, including ourselves, silver investors that think the price should be meaningfully higher. It is not easy to find silver. There are not a lot of pure play silver mines left in the world. There are not a lot of pure play silver companies left in the world. So this is a commodity that I think should be re-rated. When I think back to 2010, at the end of that year, we hit almost $50 an ounce for silver, and we're at 30, almost 14 years later. So it's one of these commodities that is still way off its all-time high. And so we think it has room to grow. So what's been driving it of late? Well, I think a lot of it has to do with solar. Solar is consuming ever increasing amounts of silver. Some of the new solar technologies are going to have higher loadings of silver in them to make them more energy efficient. So we see China really flooding the world right now with very cheap solar panels. They own this industry. The US and the Europeans are trying to wrestle market share away from them by subsidizing their local manufacturing, but there's no price comparison. I mean, China can produce solar panels at half the cost of Europeans and North Americans. Now, where all the silver is going, as I said, it's going into solar panels. China alone last year built more solar capacity than the rest of the world combined over the last 4 years. If you see these images, it's quite mind-boggling. Basically, in deserts in China, they are filling them up with solar panels. Now, what's interesting to us is trying to transport the power from the middle of nowhere, where no one lives in a desert, to urban centers requires a whole lot of copper and other kinds of metals. So that is obviously having a little bit of a benefit to that. India, from an investment perspective, has been the story for silver. As the price of gold goes up, you typically see a substitution amongst Indian investors that want to store wealth in metals versus their currency, which they don't always trust. So we've seen very strong imports of silver into India, and we see that trend continuing. Solar, we don't see going away just because the cost structure has become very, very competitive. But from an institutional perspective in silver, we don't have the same level of interest yet. There's been a lot of outflows in the largest silver ETF in the world. Our silver closed-end fund, which is the second largest in the world, it's been doing okay. We've had some days and months of inflows, but it's been kind of choppy. We have not seen broad-based institutional interest return in silver. And then the last, I think, item to highlight is the fact that, silver, because it has this hybrid role of monetary metal and industrial metal, it doesn't have the central bank buying support that you see in gold. Central banks don't hold silver. Silver is just way too voluminous to store wealth through. So we don't have that buying kind of tension from central banks. But I would say that the solar market is really playing that buying tension role right now in silver market.
Well, just tell me this. There's something you said there with regards to pure play silver. I mean, silver famously, there has been a lot of production of silver as a byproduct. People hunting for and searching for and mining other metals. And pre I guess the kind of solar revolution that we're going through, it was a fairly famously and slightly erratic metal at that. So when you identified, you said there's not a lot of pure play companies out there. And I was speaking to, I think it was Dolly Varden last week. They have a kind of pure play type silver asset, and then they have a kind of, silver gold asset. Why is a pure play silver asset more attractive than, say, something else which has it as a byproduct?
Yeah, I mean, it's a really interesting point, and we've been digging into this because when you look at some of the mining companies, I mean, what they've morphed into is really hybrid gold silver, or as you mentioned, silver is very commonly a byproduct of either copper mining gold mining, etc. So it's hard to find these really pure play silver deposits. We've obviously found a lot of them. We've mined them out over the last few centuries. And when we look at some of the ETF offerings out in the marketplace, what you realize if you really dig into them in the holdings, you find out they're really not that exposed to silver. You tend to get a lot of exposure to gold. And yes, there's a high correlation between the two, but if you're trying to get more targeted exposure to silver, it's a lot more challenging than you would think. Just because a company has the name silver in it doesn't necessarily mean that even 50% of its revenue is from silver anymore. So it is a shrinking universe. I think it's something that we're focused on. I think it's one of the reasons why investing in physical silver has been a popular way to get the pure play exposure to the commodity. But it's something that we're watching right now, and I think investor interest is definitely coming back. And I think it's going to accelerate as the price kind of strengthens here.
Right. So that kind of predictability is not there, and that's something that you with your ETF and other investments in your various portfolios, that you need that predictability to be sort of clearer with your investors. I mean, is that what you're saying?
I think investors right now have very strong views and clear views on a specific metal. And they want to express that in a pure play fashion. I think investors are becoming increasingly sophisticated and trying to understand, okay, if I invest in this company, what am I really getting exposure to? Like some of the big diversified mining companies, yes, they may be very large producers of a particular metal, but it may only be 10 or 15 or 20% of their revenue mix. So you're really not getting that intended exposure. So when we have been building our indexes with our different index partners, we're really focused on peeling away the layers of these companies to understand what exposure do they bring if you add it into an index. And we do a lot of that work at Sprott, primarily with our partner at NASDAQ. And every 6 months, we go through the entire universe of mining companies. There's about 800 of them. We go through their financial statements, and we basically rescore them in terms of what exposures by percentages do they provide based on revenue and assets across a spectrum of metals. And we select those companies and we weight those companies based on the types of exposures we're trying to express in our different mandates. So these are passive rules-based indices, but we do a lot of active work in terms of the universe construction and the weighting methodology.
Okay, interesting actually. Let's jump to gold. I'm going to romp through the metals today, folks, because you hadn't worked that out. Gold obviously ripped up past 2,400, come back a bit, like most things over the past couple of weeks. Do you feel it's going to settle here for a while, or what's your view on what the rest of this year could look like? Is it going to go again? I guess people want to know.
Yeah, I mean, I think we were really relieved to finally see it hit new highs in US dollars. And, we always remind people that gold in just about every currency in the world has already hit all-time highs way before the US dollar finally reached its level. So gold has worked incredibly well for people around the world. I mean, just think of someone living in Argentina or Turkey who's had obviously crazy inflation, currency devaluation. Just think about how these people were able to protect their wealth if they owned gold. It has incredible utility for places with shaky governments and currencies. I think we're a little bit spoiled in North America and parts of Europe where our currencies have been more resilient over time. I think the attitudes and perceptions of gold are very different between West and East, and we see that playing out in a really meaningful way this year. For many months, the gold ETFs in the Western world have been in net outflows, even though the price is hitting all-time highs. And that's been really confounding to us because you have this price action and these price signals that are very positive, but the flows are not following. Well, where are the flows going? Well, the flows are going to central banks and mostly in China, places like Turkey and Poland and Singapore. They continue to buy more gold as part of the foreign exchange mix. I think the play in China is very clear. They're trying to diversify away from U.S. treasuries, which they still hold enormous amounts of. And then the early days, it was, well, we're just going to let these bonds mature and then we'll recycle the capital. Now, it's twofold. It's not just bonds maturing and recycling the capital to gold. They're also physically selling treasuries as well to accelerate that process. And we think this is a very clear program that they're using to de-dollarize their reserves. They want to hold more physical gold. And, they're making it very clear to people as to what they are doing. Like, I remember years ago, we could go years before the Chinese officials would give us a new official number of gold reserves. They were very secretive about it. They didn't really want the world to know that they were accumulating gold. In the last few years, their behavior is totally different. They're telling us almost every month. And we got a chuckle a couple of weeks ago that led to a sell-off in gold when, China put out an announcement saying that they didn't buy any gold in the month of May because the price was too high. I just think to myself, this is just another tactic by them to try to walk the price down, that their long-term goal is to continue to accumulate not a few $1 billion, but we're talking tens or hundreds of billions of dollars more of gold as they recycle these treasuries off their balance sheet. We've seen them do this in a number of commodities, including lithium and cobalt and nickel, where they try to talk down the price. They go on these buyer strikes to, run down inventories and try to push the price down. They've done it in coal. They've done it in copper. This is a very standard playbook. It works in the short term, but I don't think it works in the medium to long term. And I think the upward trajectory for gold is still there. The positive fundamentals are there. If we could get Western institutional and Western retail investors joining the party, I think the move on the gold market will really go.
Yeah, I think it's interesting times, and it'll lead nicely onto a conversation on uranium in a second, certainly around the sanctions component anyway, where we're seeing it's not just China, it's Russia, it's the BRICS countries are making strides to de-dollarize, which and obviously it weakens the power of U.S. sanctions, which is a bit where I want to go in a second, and the dependency, and I guess the importance of what the U.S. Would like us to be doing, or like us to be, how they want us to behave. For gold, it continues to be good news. Slight reset at the moment, but your view is it will go again. But I guess the question I'm thinking about here is, in terms of that buildup of it's not just a case of buildup of inventory; it's the buildup and that store of value for central banks, which is only really been in fashion for the last 2 years. What do you think? Is there a point at which, when they stop buying that gold, obviously that should possibly be affected, and where will we be at that point?
Yeah, I mean, as you mentioned, central banks for many years were reducing, and sadly, where I live in Canada here, we sold all of our gold at very low levels years and years ago. But I think the bigger picture trend to focus on with the BRICS or BRICS Plus or whatever you want to call this new group of countries that are kind of banding together and forming their own kind of block of power are clearly trying to move away from the U.S., being beholden to the U.S. dollar and U.S. treasuries. Given their economies are becoming much larger, they're obviously becoming very large trading partners amongst themselves. They don't want to settle everything in U.S. dollars anymore. They do not want the U.S. dollars to be the primary, trading currency for a number of these different commodities, etc. And so we think this de-dollarization trend is only just starting. And the central banks that are growing in terms of adding to reserves is only going up. It's not just China. China's been the leader, but there are a number of central banks around the world that seem to be embracing the role of gold again as a financial commodity and as an alternative currency. So we think this trend is going to play out for a long time. It definitely provides a lot of buying support for the metals price. And as I said, if we have this continued central bank buying and you get a return of institutional money, I think it could be very powerful. Now, what prompts institutional money? It's mostly insurance, the need for insurance. They think of gold as an insurance policy in their portfolio. insurance policy against what? Could be equity risk, could be a geopolitical risk, could be credit risk, it could be some kind of calamity in the financial system. And right now, it doesn't seem like anybody's too worried about anything. So we have not seen this movement back to gold as, amongst the institutional cohort that tend to hold gold more on a transitory basis.
I mean, we've seen obviously with COVID and supply chain issues and printing of money and pressure under most economies around the world, the effect on the available cash in the average households, and therefore their disposable income and their discretionary spend. If this de-dollarization trend continues, do you see a bit of pressure in terms of North American households, and then and the knock-on effect in terms of their ability to invest in kind of mainstream stock investment, for instance? Because that could that may from a retail perspective, and I guess some of these funds as well, may affect their inflows, and there's a knock-on effect to you. So how do you read the kind of risks as well as the rewards of this de-dollarization?
Yeah, I mean, obviously the U.S. has been able to print enormous amounts of money without a lot of impact. The world, while they're trying to knock off King Dollar is still sitting on the throne. So, this is part of a longer term, I think, geopolitical shift. I think the psychology right now with investors is there's a lot of money still sitting on the sidelines. The Fed has not moved interest rates as quickly as everyone thought 6 months ago. And there's trillions of dollars sitting in U.S. money market funds alone that eventually is going to have to come and find a new home when rates start to normalize. I think that could have a profound impact across a number of different asset classes. But right now, we still see this stay on the sidelines, make 4 or 5% risk-free, see how some of these things play out in the market. But there's a lot of dry powder kind of sitting on the market looking for signals.
Yeah, interesting. I mean, how does a company like you react to, potentially a new brick currency? You've got your various ETFs, some of which we're talking about now, and there's more we will talk about. But would you look to list on additional exchanges as a kind of hedge against what may come?
Yeah, it's something we've considered from time to time. I think, our existing precious metals products have pretty good institutional interest and ownership across the globe. There are challenges to launching products in markets where you don't have a strong beachhead or your brand is not well known. So, we've tried to stick to markets where we think we can compete effectively. But I think, the big picture situation that we really focus on is the fact that the world is still incredibly underweight all things commodities. And I think institutional investors are starting to rethink that position. They have for the last 1 or 2 years. We constantly are talking to institutions that are interested in learning more about different metals markets. And many of them will tell you right out, like, hey, we've never invested in this, or we haven't invested in this space for 10 or 12 years. But they're intrigued again because there are interesting signals, whether they're price signals or geopolitical signals or energy policy related signals that they just can't ignore. So we're engaging with people on a whole host of different metal categories. I would say the predominant interest has clearly been in, let's call them energy metals, things like uranium, copper, for sure. The bigger picture theme of decarbonization, electrification, energy security, I think has attracted the lion's share of capital the last 2 years, whereas precious metals have been kind of put on the sidelines because, again, people don't see the immediate need for, this kind of insurance policy with gold. Now, I'm, referring to Western investors. Eastern investors are accumulating gold like there's no tomorrow. We didn't talk about Chinese retail investors going back to gold. Why? Well, the real estate bubble has finally popped in China. That's been an area of massive speculation in the last few years. The stock market hasn't performed well. They're not allowed to invest in Bitcoin. So what are Chinese investors doing with their capital? Well, they're going back to what they know best, things like gold. And they've been buying a lot of physical gold as well.
Well, I think interesting times for them ahead on that, and we'll see what the timing is for that as well soon. Let's jump to something we're a bit more comfortable with, which is, in fact, we should also talk at maybe a later date. Copper. You have plans on copper. We want to hear all about it, but we can end up when you're ready to talk about it. Uranium. It's followed this trend of going on a tear. Was 25% above today's dollar price of $83. Things moving a little bit slower there. It's a little bit quieter at the moment.
Yeah, I mean, I think the reality is we're taking a breather and we're consolidating the gains that we built from last year. We've always advocated that the price is going to follow kind of a staircase pattern. Last year, we had a huge breakout from the 50s. We hit all the way up to 106 in January, and we've since been kind of trading in a range, kind of 83, 84 on the low end, and kind of 93. So we've been kind of oscillating in this $10 range for the last few months. Not unexpected, given we were in the mid 50s last summer. We are, I feel, as though in a little bit of a lull in terms of information and news flow. This happened last summer, where June, July were very soft in the market. There wasn't really a lot happening. Sentiment kind of washed out. I remember very vividly talking to some clients that were frustrated last July and said, something's just not working here. I'm moving on. And then lo and behold, what happened? August, September, it just took off. So it's bound to do that, in our opinion. Everyone seems to be waiting for news from the Kazakhs about production in 2025. They were supposed to tell us in March, and they told us that they won't be telling us until August sometime. Everyone's just kind of scratching their head around what does this mean. I think it's clearly a shift in policy around flexing up production in a meaningful way, which they signaled, last October, to now a new focus on value over volume, which is another way of saying we're going to hold back production and maximize the value we can extract out of our strategically valued uranium deposits. I think this is a clear shift in strategy for them. And I think it bodes well for the longer term price of uranium because, we've always said bull markets die when the low-cost big producers flood the market with material. And if you look around the globe and you say, well, who would be capable of that? Well, you obviously have to start with the world's largest producer. The fact that the world's largest producer has shifted their strategy quite dramatically in the last 7 or 8 months, I think tells us this market is going to go higher for longer. And this is what we've been telling people, that this is not like a spike, super cycle spike kind of market like we saw in 07. This market is going to play out, we think, more similar to what happened in the 1970s, which again, we had an oil shock, energy crisis that propelled the price of uranium up to very high levels and kept it there for many years. And that's exactly what you need to basically rebuild a supply chain. You can't have 3 months of fairly high prices and then it fades away. And people don't make long-term, large-scale capital X investments based on, 3 or 6 months of price action. They need to see high prices, not for a few quarters, but for years to make those kinds of investments. And the world needs those investments. You cannot expand nuclear energy like the world is saying they would like to do without making these investments in the production of the mineral. So this has been our thesis all the time. The volatility is at times gut-wrenching. We constantly have institutions calling us up saying, hey, what's going on in the market? Is there any news? What's happening? Why is this price happening? And it's often, no, there's not a lot of news. Am I missing something in my thesis? Has something changed? And every single time it's no, everything is pointing in the right direction. You get these kind of air pockets and they flush some people out. But I think the longer term trend is clearly higher and for longer. And so That's what we've been advising people. You just have to, you just have to be patient. You have to be, take advantage of some of these disruptions and dislocations in the market, because they can provide really interesting buying opportunities, particularly for people that kind of miss the first part of the move. We would often, speak to institutions and say, oh gosh, why didn't you call me 2 years ago with this? And I said, well, we probably did talk to you, but you didn't move. So these entry points, I think, are attractive for people that have not got positioned yet. And, dollar cost averaging, so to speak, in terms of buying into these kind of dislocations, I think is a really helpful way to use the volatility to your benefit.
Yeah, I think you're right. The trend is still facing the same direction, folks. It hasn't been a volte-face change in sentiment about where our energy needs are going to come from. One thing that has changed is, say, perhaps the strategy of Kazatomprom, and also the direction of those pounds that are produced. It seems cozying up to China, Russia, etc., to pick up those pounds. What I'm trying to understand, what is that going to mean for us in the West in terms of, we're saying the demand trend is just getting better and better on a daily basis. We're seeing lots of announcements about countries, going nuclear and funding getting permissions and then helping with the funding and of those bills. Supply, not much has changed. Not a lot of new producers coming online anytime soon. We've got I think three in the US back in production at the moment. It's not going to be enough. So what gives?
Yeah, I mean, a few weeks ago, the Department of Energy Secretary Granholm had a press conference saying the U.S. wants to triple their nuclear capacity. So just, put that in a context. They have around 90 odd reactors today. So you're talking about a massive build out going from, energy, uranium annual uranium requirements of, say, 50 million pounds to, I don't know, make up a number, 150 million pounds a year. I mean, the industry is only producing about 150 million pounds in totality this year alone. So it was a pretty bold statement, and I kind of applaud their support. The feasibility of actually doing that and building everything from upstream to downstream is very aspirational at best. So it's a big challenge. And I think, as I talk to people around the industry, it's interesting. I keep stumbling on people that say, we've had conversations from officials from this government and that government that are very focused on uranium and copper and other critical minerals, because they understand that unless you have security of supply of these critical minerals, these aspirations related to energy policy or energy security are just really press conferences. And the industry needs to make these investments. And as you said, yes, we're restarting all the brownfields. It's great. We're getting back into production and places like Africa, Canada, Australia, the US. The Kazakhs are trying to figure out some of their own supply chain issues. But the industry is still in a structural supply deficit. We might produce 150 million pounds this year. The industry still needs 180 million pounds a year, and that number is only going up every year from here. So the big challenge for this industry is greenfield. That's going to make the difference. That's going to add meaningful pounds.
So I'm struggling to find out what do we do about this one, because you kind of got these big infrastructure bills going out around the world, hundreds of billions of dollars of infrastructure bills, whether or not they're kind of rehashing old coal-powered fire stations or not. All these bills cost a lot of money. SMRs being tested at the moment, and they all need feed. I don't think the government funding seems to be focused upstream. It's all downstream in terms of enrichment, conversion, etc., which we also need. But there seems to be an awful lot of help needed by some of these companies in terms of, at the very least, helping with the kind of shortcutting of a process for permitting and licensing. That's a great start. Money would be most welcome too. But the junior space has been absolutely hit hard. And you'll know from the gold space, we've seen lots of kind of mergers of equals. BHP, Anglo failed, but lots of other mergers of equals where the majors just want a shortcut through to increase resource and reserves. They do not want to go and expose themselves to the expense or time or pressures of finding, in that case, ounces. But, in case of uranium, pounds, needs to be more joined up thinking, surely. And it's not there yet, is it?
No, you're right. I mean, you raised a couple of really interesting points. I mean, the Russian uranium enrichment ban also brought with it several $billions of government funding to support the reshoring of not uranium mining, because that's not what Russia does, but in the conversion enrichment steps, which Russia, obviously, we are still reliant on for those services. But you're right. Companies, it's very interesting to us when companies are more focused on mergers than building. That tells us that we're not at incentive pricing for the commodity to warrant the upfront capex for new projects. And so people might think, oh, well, the prices run a lot, it's over. Well, if the price was high enough to incentivize new production, we'd see these announcements. Instead, people are jockeying for position to try to acquire these critical minerals because they know the prices are going up, and they know that we're still in a period where we're not quite yet at incentive pricing to build some of these projects, which are going to need higher levels, whether it's copper or uranium, etc. So to us, it's actually a bullish sign. When companies are more focused on buying than building, it tells you there's more upside in the price before we start getting a supply response.
Yeah, for sure. Well, I think we've had a sort of decent romp through a few metals in it. What is we're heading towards it feels like a bit of a summer lull at the moment across the board. People waiting for the next catalyst events here, but things going well at Sprott. Obviously, a few new ETFs popping up, and I think, in my opinion, a very large percentage of retail should be in ETFs if they're not already. Should be thinking about that. Takes a lot of pressure off. And then perhaps they not feel so bad when things don't quite go according to plan with your own personal picks. So have a look at what these guys are doing. We'll put some links in the description below. And John, as always, thank you very much for your insights. Appreciate it.
Always great chatting.